Okay, so if you were watching the markets recently, you probably saw it. Gold, silver, and yeah, even Bitcoin just took an absolute nosedive. We're talking the fastest drop in over a decade. It was huge, it was sudden, and it left pretty much everyone asking, what on earth just happened? Let's get into it.
So what's the deal? I mean, what could possibly trigger such a massive, rapid sell-off in assets that are supposed to be your safe havens? What could spook the market that badly, that quickly?
Believe it or not, this entire market shockwave, this crazy plunge in gold, silver, and crypto, it can all be traced back to a single announcement made by President Trump. It literally all comes down to one name. But first, let's just take a step back and look at how dramatic this whole thing really was.
I mean, look at this. These three assets had been on an incredible run, just performing great, and then bam, they all fell off a cliff at the exact same time. This wasn't some slow, gradual decline. It was a sudden, violent drop that had investors just scrambling, trying to figure out what was going on.
And you know, this quote really gets to the heart of why people own gold in the first place. It's not like a stock that's supposed to make a profit or pay a dividend. Gold doesn't do anything. It's a hedge. It's basically an insurance policy you buy when you're worried about everything else. So, to really understand why gold crashed, we have to first understand the fear that was driving people to buy it up. You gotta ask, what were investors so afraid of that they were buying all this insurance? And the source of all that fear really centers on this one institution, the Federal Reserve Bank. You know it as the Fed. Their job, put simply, is to manage the U.S. economy by controlling interest rates and, printing money. And here's the crucial detail. The Fed is designed to be independent of the government, to make its calls without any political pressure. Well, lately, that whole independence thing has been a major topic of conversation. President Trump has been really clear about what he wants: super low interest rates, a weaker U.S. dollar to help with exports, and a Fed that basically answers to the White House. Now, for a lot of investors, you add all that up, and it screams one thing: a potential dollar crisis and runaway inflation. And when people get scared their dollars won't be worth as much tomorrow, where do they go? They often go to gold.
And we have absolutely been in one of those periods of high economic fear. If you look back at history, gold really only outperforms the stock market during huge, scary crises. We saw it in the Great Depression, the stagflation of the 70s. That's when you have high inflation and high unemployment, just awful. The dot-com bust, and of course, the 2008 financial crisis. The fact that it's been happening again tells you that investors have been genuinely worried.
So you've got all this fear and uncertainty just building and building in the background. And then one single announcement comes out, and it changes the entire story in a flash.
The announcement was President Trump's choice for the next chairman of the Federal Reserve, and the name was Kevin Warsh. The moment that name hit the newswires, the markets just reacted.
Which, of course, brings us to the big question: who is this guy? And more importantly, why would the simple mention of his name make investors suddenly want to dump their insurance assets like gold and silver? Okay, let's break down exactly what Wall Street heard when the name Kevin Warsh popped up. It's really simple when you see it side by side. On one hand, you have everything the market was afraid of: a weaker dollar, a Fed controlled by politics. On the other hand, you have the wave of relief that came with Warsh's name. The market sees him as someone who wants to protect the dollar, keep inflation under control, and, this is the big one, maintain the Fed's independence. He's seen as the direct opposite of what the market was freaking out about. You can almost hear the collective sigh of relief from Wall Street. The thinking was that a more level-headed person was coming in, someone who would protect the value of the dollar. And with that big fear suddenly taken off the table, the need for that insurance policy, gold and silver, seemed way, way less urgent. Okay, so what's the big lesson here for you and me? This whole event is a really powerful example of the difference between being a true investor and just being a chaser.
A huge part of what made this crash so bad were the chasers. These are the folks who bought gold just because the price was going up, because of the hype. They didn't really understand why they were buying it. So when the news turned, they panicked and sold, which just made the crash even worse. A savvy investor, on the other hand, has a strategy. They see a panic-driven dip not as a catastrophe, but maybe, just maybe, as a buying opportunity.
So the big takeaway here isn't really about gold. It's about having a playbook for yourself. You have to understand why you're investing in something, not just that its price is going up.
That way, when the headlines change in an instant, and trust me, they will, you can ignore all the noise and maybe even spot an opportunity while everyone else is running for the exits.
Because at the end of the day, markets are always going to move, and a lot of the time, they're going to surprise you. News creates emotion, and emotion creates volatility. So the real question this leaves all of us with is, the next time it happens, are you going to be the one caught up in the panic or the one who sees the opportunity?